March 25th, 2021. Credit Suisse's risk systems posted a number: $5.5 billion. Not a paper loss, not a projected exposure, a real, finalized, unrecoverable loss, processed in 48 hours. Here's what didn't cause it. No elaborate fraud, no shell companies, no forged documents, no criminal mastermind running a 20-year scheme from a beach in the Cayman Islands. What caused it was a family office, a specific type of legal entity that, by design, is not required to report its holdings to any regulator. And on the night it collapsed, one of Credit Suisse's own risk analysts learned something for the first time. Archegos Capital Management had been running simultaneous positions at 6 major Wall Street institutions: Morgan Stanley, Goldman Sachs, Nomura, Deutsche Bank, Wells Fargo, and Credit Suisse itself. Not one of those banks knew the full picture. Every single risk system at every single bank was looking at a different piece of the same puzzle. That's the bomb. That's how it was built. Let's go back 18 years. 2003. A hedge fund called Tiger Asia opens a relationship with Credit Suisse. The man running it is Bill Huang, a Tiger Management alumnus, one of the most prestigious pedigrees in the hedge fund world at the time. The relationship starts simple: cash equities trading. By 2005, Tiger Asia is a full prime services client, trading equity swaps. By 2016, the fund's net asset value had grown from $500 million to $3.9 billion. Credit Suisse's internal credit review that year described the fund as having a solid capital base, an experienced management team, and strong performance. The fund had been renamed by then. Tiger Asia became Archegos Capital Management. The reason for the rename? 2012. That year, Tiger Asia and Huang settled insider trading charges with the SEC. 3 Chinese bank stocks, short sold on confidential information obtained through private placement offerings. Same year, Tiger Asia pled guilty to wire fraud with the DOJ. Total payments: $44 million in fines and disgorgement. 2 years later, a Hong Kong tribunal banned Huang personally from trading securities in the territory for 4 years. Credit Suisse knew all of this. It's in the files. Their decision? Keep the client. The internal justification is documented in full in the Paul Weiss report. In 2015, years after the SEC settlement, months after the Hong Kong ban, Credit Suisse's compliance team finally pushed through a reputational risk review of Archegos. The business submitted the following conclusion: Credit Suisse is comfortable continuing its prime services relationship with Archegos Capital at this time, as this was a one-time incident over a 20-year-plus career. We believe this is an isolated, one-time event. Mr. Huang has accepted the verdict and subsequently paid the fine. One isolated incident, a guilty plea, an SEC settlement, and a 4-year market ban, filed under isolated, one-time, move on. The annual revenue Archegos was generating for Credit Suisse at that point? $6.6 million. That's the number Credit Suisse decided was worth the reputational exposure. $6.6 million. Against what would eventually become a $5.5 billion loss. Keep that ratio in mind. Now we need to talk about static margining, because this is where the physics of the disaster actually lives. Credit Suisse's prime services operation ran 2 parallel businesses. Prime brokerage handled cash equities, traditional stock financing. Prime financing handled derivatives, primarily equity swaps, synthetic positions that let a client gain economic exposure to a stock without directly owning it. Prime brokerage used dynamic margining. Position grows, market moves, the system automatically recalculates and calls for more collateral. Standard. Prime financing swaps until 2019 used static margining. Here's what that means. When a swap is initiated, the margin is calculated once, based on the notional value at that moment, and then that number is locked. It doesn't move. The position can double in value, triple in value, generate 10 times the original risk exposure. The initial margin requirement doesn't automatically adjust. In 2017 and again in 2019, Archegos negotiated its swap margins down, first from 15 to 25% to somewhere lower. Then in 2019, all the way to 7.5%. The negotiating leverage was simple. Another prime broker is offering me better terms. Match them or lose the business. Credit Suisse matched them. The internal analysis at the time of the 2019 agreement showed that, as applied to Archegos' portfolio at that specific moment, the combined margin across prime brokerage and prime financing covered nearly 3 times the exposure under a severe stress scenario. That analysis was correct, at that specific moment. The problem with static margining is that the moment passes, the position grows, the notional value expands, the margin stays fixed. Every day after that, the actual coverage ratio quietly erodes, and the system doesn't automatically flag it, because by the system's logic, nothing has changed. By September 2020, Archegos' total portfolio at Credit Suisse had reached $9.5 billion. 74% of that was held in prime financing swaps, margined at an average of 5.9%. The math on that coverage ratio is not good. Spring 2020. The alarms start firing. Archegos begins breaching its potential exposure limit, the PE limit. This is a risk metric designed to measure the maximum loss Credit Suisse could face if Archegos defaulted. The limit was set at $20 million. By April 2020, Archegos' PE reading, $200 million, 10 times the limit. By August 2020, $530 million, 26 times the limit. These numbers were being reported to Credit Risk Management, to Prime Services Risk. Both teams received the data. Their response was to question the metric. Credit Suisse had revised its PE calculation methodology in January 2020. Risk personnel had developed concerns about whether the new model was overcounting, so they discounted the readings. They decided the alarm was probably miscalibrated, not that the risk was real. At the same time, a second metric was breaching: scenario exposure, the estimated loss under a simulated market stress event. Limit: $250 million. By July 16, 2020, Archegos' scenario exposure, $600 million, 240% of the limit. 1 week later, $828 million, 330%. From that point, Archegos remained in breach of its scenario limits virtually every single week until its default in March 2021. The alarms ran continuously for nearly a year. Nobody pulled the fire door. September 2020. Credit Suisse convenes the first meeting of a newly created committee, the CPOC, the IB Counterparty Oversight Committee. This committee was created specifically in response to a previous hedge fund blow-up, Archegos Capital, which had cost Credit Suisse $214 million earlier that year. Lesson learned. New governance structure. Fresh start. Archegos is one of the counterparties presented at the inaugural CPOC meeting. The meeting materials describe Archegos as making substantial use of leverage relative to peer funds, exhibiting a highly volatile performance pattern, and generating some of the largest scenario exposures in the global hedge fund portfolio. The committee's decision, as recorded in the minutes, action/decision, CRM to notify of any changes with the counterparty and revisit the counterparty at a future meeting. No deadline, no remediation target, no hard timeline. CPOC did not discuss Archegos again for 6 months. In those 6 months, Archegos' risk exposure more than doubled. Let's do one number. By the time of CPOC's second discussion of Archegos, March 8, 2021, the materials showed that Archegos had a gross market value exposure of $21 billion at Credit Suisse. The next largest client on the same desk? $5 billion. Archegos was 4 times bigger than the second largest name, running on average swap margins of 8 to 9%, with 5-year annualized performance volatility above 70%, and a credit rating that had just been downgraded to the bottom third of Credit Suisse's entire hedge fund counterparty book. And not one person at Credit Suisse had visibility into what Archegos' total exposure looked like across all its prime brokers combined. Because legally, Archegos didn't have to tell them. Family offices are exempt from the SEC's large position reporting requirements. Total return swaps, the specific derivative structure Archegos used, don't appear in the standard 13F filings that public investors and institutions file quarterly. Every bank was modeling its own risk in isolation, with no mechanism to see the aggregate. The blind spot wasn't a failure of diligence. It was baked into the regulatory architecture. March 8, 2021. CPOC finally reaches a concrete conclusion. Archegos must be moved to dynamic margining. The action item is assigned to the head of Prime Services Risk, with a target completion date of April 2021. That's the urgency level. 6 weeks. What happened next is the part that doesn't make most summaries of this story. On February 10th, before the CPOC meeting, Credit Suisse's software team had already run Archegos' swap portfolio through the standard prime brokerage dynamic margining rules. The result? Under standard rules, Archegos would owe a day one margin step-up of $3 billion. $3 billion. Day one. The head of Prime Services Risk received that number. He did not share it with credit risk management. Instead, he instructed his analyst to build a separate, more lenient set of dynamic margining rules, one that would generate a day one step-up of approximately $1.27 billion, less than half. The reasoning, per the report, he didn't want to present Archegos with terms aggressive enough to damage the relationship. The proposal went to Archegos on February 24th. Archegos' response, "Let me get back to you." March 11th through March 19th, 8 days. While Archegos was reviewing the dynamic margining proposal, it was doing something else simultaneously. It was withdrawing its excess variation margin from Credit Suisse. March 11th, $740 million transferred out. March 12th, $650 million. March 15th, $200 million. March 16th, $76 million. March 17th, $145 million. March 18th, $230 million. March 19th, $400 million. Total, $2.4 billion extracted in 8 days. Credit Suisse approved every single request. Nobody connected the two threads. Archegos stalling on the margin negotiations. Archegos pulling cash out of the account. 2 data points. Same counterparty, same week. Nobody put them together. On March 19th, the head of PSR had scheduled 3 separate calls with Archegos, each one after market close, to push the dynamic margining agreement to a close. Archegos canceled all 3, each one at the last minute. March 22nd, 2021, Monday. Viacom CBS announces a stock offering, $2 billion in Class B common shares, $1 billion in mandatory convertible preferred stock. The market receives it with visible indifference. Viacom CBS was Archegos' single largest long position. Gross market value at Credit Suisse alone, approximately $5.1 billion. That Monday, the stock drops 6.7%. March 23rd. Archegos still holds $606 million in excess variation margin at Credit Suisse. March 24th. That $606 million is gone, erased by market movement. Archegos now owes Credit Suisse $177 million in variation margin. It pays. Same day. Tencent Music Entertainment, another major Archegos long, drops approximately 20% in a single session. That evening, Credit Suisse's head of equities calls Archegos' CFO. The CFO says, "While we have a $20 billion NAV and have met every margin call until now, we no longer have the liquidity to meet tomorrow's call, or any other calls from our other prime brokers." That was the first time Credit Suisse's head of equities learned the full scope of Archegos' positions across the street. That was also the first time he learned that the $6 to $7 billion in unencumbered cash that Archegos had been citing as a liquidity buffer, the same buffer that had been used to justify Credit Suisse's accommodative approach for 2 years, had already been consumed by margin calls at other institutions. March 25th, morning. Credit Suisse issues 2 margin calls, prime brokerage and prime financing combined, totaling over $2.8 billion. 12:30 p.m. Archegos confirms it will not pay. That evening, Archegos convenes a call with all its prime brokers. On that call, the full picture surfaces for the first time. Total gross exposure across all counterparties, $120 billion. $70 billion long, $50 billion short. Archegos asks every bank on the call to sign a standstill agreement. No default notices, coordinated liquidation, orderly unwind. Morgan Stanley and Goldman Sachs quietly begin liquidating while the negotiation is still happening. Credit Suisse hesitates. That hesitation, while other banks were already selling, meant Credit Suisse was still holding near full exposure into a market that was about to absorb simultaneous selling pressure from multiple institutions at once. March 26th. Credit Suisse issues its event of default notice. By then, it's too late to matter. Final loss, $5.5 billion. The Paul Weiss report runs 172 pages. Its core finding fits in 5 words: failure to act on known information. Not unknown information, not a black swan, not a market event that nobody could have modeled. The risk systems identified the exposure. The scenario metrics breached continuously for 12 months. 2 separate CPOC discussions named the problem explicitly. The dynamic margining technology existed and was already deployed for other clients. The contractual right to call additional margin or terminate the swaps entirely was available every single day. Every tool was in place. Every warning was visible. One CPOC member, interviewed by Paul Weiss, described the committee's discussions as collegial. No real challenge to the business. No sense of urgency. CPOC, in his words, had no teeth. In a collegial room with no teeth, a $21 billion exposure sits on the books for months, discussed, acknowledged, and not acted on, until the market makes the decision that the institution couldn't. This is not a story about greed. Greed implies intent. Intent implies a decision. This is a story about a system that learned to be comfortable with its own warnings. Subscribe to the White Collar Autopsy. We'll see you in the next dissection.